Right, welcome everyone to our second ESG Tracking Study webinar. My name is Heather Hopkins. I'm the Managing Director of NextWealth, and I am really pleased to be joined by Clive Waller, Jeannie Boyle, and James King. We're getting the band back together for another webinar on ESG. Clive, Jeannie, and James, do you want to introduce yourselves before we get into this?
Okay, I'm Director of NextWealth and was part of this research and part of the research. I also run the Schroders UK platforms and the investment network in my spare time, but my core business has always been research, and ESG is a pet subject of mine. It has been for some time.
Jeannie?
Hi, I'm Jeannie Boyle from EQ Investors. I'm a director of the business and I'm a client advisor as well. And I work almost exclusively with clients who are interested in sustainable investing.
And James?
Hi everyone, James King. I'm the managing partner at King Financial Planning. Previously was a partner in Price Bailey Chartered Accountants and Tavistock Private Client. I'm just an advisor that's very interested in the ESG world and going through a bit of a journey, and the plan is to try to explain to you the very little parts that I actually know. Great,
thank you. Jeannie and James, you're both really, really thoughtful on this subject and have done a lot of work on it. So, and I know that the last webinar, the feedback was really, really positive. So looking forward to the discussion. The other person who you can't see, who's got his video hidden, he's going to be coming in just towards the last bit of the webinar, is Alex Johnson, quantitative researcher for NextWealth. And he's going to be sharing 5 questions that he thinks you should be asking your clients in a client survey to assess demand for ESG investing. So without further ado, I'll see if I can go forward to the next slide. So it would be remiss of me not to thank our fantastic sponsors. So this lovely group of asset management firms, platforms, research houses supported this research. And of course, without their generous support, we couldn't make it free to all of you. So if you are considering any product choices in future, we hope they're on your list. The research this is the second update to this report. So we did a report in October, and that was based on a survey of about 350 advisors. And this is an update to that research, again, based on a survey of advisors and in-depth interviews. So what we found, so onto our first slide on client demand. So we asked financial advisors to get their perspective on how often this is coming up from clients. So how often are clients bringing up the topic of ESG impact, sustainable or ethical investing in their meetings? And the reason we used those 4 different categories is because we didn't want to get into any discussion about labels. We wanted to really capture the widest possible definition of this approach to investing. So about 20% of advisors say, or it's coming up in about 20% of client conversations, and that's trebled since the first time we did this study, or the first time we asked these questions. We didn't actually publish a study on it at that time, but in Q3 2019. And you can see from the chart on the right hand bottom side of the slide that 2/3 of advisors expect demand to continue to increase, or interest continue to increase. The thing I think is really interesting about this, and you'll see this consistently throughout all of the slides, is that there was a real jump between 2019 and 2020. And then we're seeing this sort of continued rise, but slower since then. So it's only been 6 months since we did the last survey, but you can see that growth curve is slowing down. And we see that consistently throughout the research. And what we heard from advisors is the discussion about the regulator was going to require a question about this, or advisors to cover this in their suitability with clients, really drove that adoption. And Clive will come into some of those thoughts later on. So in terms of advisor implementation within the business, so most advisors have said since 2 years ago when we first started asking these questions that clients had some assets invested in ESG, ethical, impact, or sustainable funds or solutions. That was 83% in 2019. And our most recent survey, I can't see it's behind my camera, 96%. And the percentage of assets that are going into these funds or solutions is 15%, doubled over the last couple of years. But again, that pattern of nearly doubling from 2019 to 2020 and then continuing to eke up, but not the same jump in growth. Although, as you can see from that last bar, most advisors expect the allocation to continue to increase. Last slide from me before I pass on to Clive. We asked about the inclusion of a question in the KYC or fact find on ESG, ethical impact, or sustainable investing. And 83% of advisors said that they have a question in their KYC or fact find. And that's up a little bit since the last time we did the survey. The really interesting shift has been around the terminology that's being used and the heading under which that falls. So ethical continues to be at the top. 72% of advisors say that it falls under the ethical heading, and that's up from 64% 6 months ago. But the real shift is, look at that jump in the proportion they're saying it falls under the sustainable heading. So 44% compared to 12. ESG, the next most popular. Thematic was a new category we asked about this survey that we hadn't asked about before. So some real movement. And I think that's really encouraging because we think that ethical is different actually than ESG. And we can have a discussion in the Q&A about that if you'd like. But the other thing is that it's being approached from a number of different angles. And so it's not a single binary sort of topic. It's being approached from a number of different places because different customers have different language and terminology that they use. Clive, if I could pass to you, please. I'll move forward a slide.
Fair enough. Okay, the answer weren't a surprise, but I think they're interesting. We asked advisors whether they should offer branded funds in addition to their general kit, whether ESG should be acquire across the board and be normal practice, so within the kit, and those who believe the earth is flat and is going to stay as ever was. The majority of 56 to 26 are looking at branded funds, and this is very, very understandable, but possibly the wrong way in the longer term. If you look at asset managers, they're either, if you look at, say, Schroders or JP Morgan or Janus Henderson, they are applying ESG criteria across all stock selections they make. Now, whether the actual fund manager takes that on board, not varies from manager to manager. Some may say they can override it, some they can't. But that's going towards the future where ESG is seen as a risk factor as well as the sustainable issues. The branded funds, sadly at the moment there's no regulation in the UK, but there is in Europe under SFDR, Articles 8 and 9, are going down a particular ESG road, and they'll be different. They may be branded ESG, they may be branded sustainable, responsible, thematic, impact, whatever. The slight concern we have about that is that as more and more integration takes place in mainstream funds, we see advisors having to change, and that could be slightly awkward in terms of justifying to their clients why they change. And we'd suggest to advisors they very strongly think about their own proposition and trying to match it to the majority of their clients. If their clients are specialists, don't go there, go to a specialist DFM or DFM, or to another advisor who's a specialist, because specialist clients will need a specialist IFA. Next slide, please, Heather. Right, the other issue in terms of what advisors think about ESG funds is whether they're riskier, more expensive, will underperform. The issues one looks at with funds across the piece. Surprisingly benign, really. The biggest factor there is 19% think they're worried about the cost of ESG being higher, which is quite right on the whole, for two reasons. One is there might be more research, there might be more cost there, might be more cost to the advisor. More importantly, an awful lot of advisors are going down a passive route, and it's potentially harder to go down the passive route if you are a passive investor or a passive IFA recommended passive funds. Now, Jeannie will talk about that. EQ have got a very interesting and very plausible solution. But on the whole, the majority of ESG funds and sustainable responsible funds are active. Some think it'll be the return of active management. We'll see. In terms of risk, you should be lowering risk with proper ESG. The whole point about ESG is to look at climate change risk, sustainability risk. It should be lower. If you, however, you go into the specialist areas such as thematic and impact, they are by definition subsets, and in some cases will be riskier stock, which could make magnificent returns or poor returns. That should be very well understood by the advisor. And the important thing there is to blend the portfolio together so the overall blended portfolio matches the client. In terms of performance, we'll see short-term shifts. I was rather annoyed that people were bragging about ESG performance so well last year. Well, of course it did. Nobody was going anywhere. And there'll be a counter to that as miners and commodities go up post pandemic. That's far too short term. Long term performance of ESG, we think, will be better because if your product is sustainable, it's going to make more money over time. We're seeing that particularly with oil companies at the moment. Next slide, please, Heather. Lastly, I think it's lastly, the gatekeepers, as it were. One thing we do stress to advisors is you need to be able to evidence why you're using the products you're using. You can't do the research, the amount of research is used. So you've got to have a research partner who you trust. And we think you've got to ask them the difficult questions about quantum core research, what rating agencies they use, if they use any, how they're using them, etc., etc., etc. The favoured partner today on our last research is FE Fund Info. Not surprisingly, they've got the biggest number of users in the small, medium-sized IFA community. Morningstar, of course, are close up behind them. Morningstar led the way in ESG because they had a partnership with Sustainalytics going back 6 or 7 years. And subsequently, they bought them, I think, last year. Other agencies, particularly Square Mile, have done a huge amount in the ESG area. And MSCI are probably the leading ESG data provider. So I'm looking for Jeannie to nod or shake her head there. I think they're probably the leading data provider. The problem at the moment, though, our data is subject to disclosure by companies, and we're waiting for that to change. We will do under 2CFD and SFDR, but that could take 3, 4, 5 years. But we are where we are. I think that's me down here, is it? Oh, is it?
Yeah, great, thank you. So let me stop sharing, and I should mention if there are questions from the audience, then feel free to put those through. So James and Jeannie, now we're going to put you in the hot seat. James, if I could start with you, I think this is a really interesting sort of trajectory that we've been on. That at our last webinar, Jeannie talked about one of the things that they did at EQ Investors was a survey of clients to assess interest in ESG investing among clients, because there's often a lot of talk at a firm level about interest, but great, let's ask our clients. I know that you've recently done a survey of your clients, James. So I was wondering if you could talk a little bit about that.
Yeah, sure. As you said, when we did the last webinar, I was very much the novice of the panel. I still am. So I'm no expert by any means. So I'm definitely put my hand up to that. But where I am, and I think where many advisors and probably on this call are, is there's obviously an interest in ESG. They appreciate that there's a new world coming, and actually people want to understand how they put this together. So when we did this last time, I said that one key thing that we don't do as an industry very often is actually ask the end client. We all see millions of I must get 5 or 6 emails from different product providers every day about ESG in one way or another. But that's to me. But nobody ever asked the end client, and actually, do they really understand this stuff? And I thought, well, that was pretty important. So before I talk about, I suppose the thing that I've started to get my brain around is trying to put a proposition in place that fits for my client bank, for those people that are interested. And I think there's an extra part, isn't there, with the whole ESG piece, because we all have now got that sort of slightly sausage machine mentality with our clients. We go in and we risk profile clients, we do our fact find, we then get to a point where we put a portfolio together, then we report, then we do evaluations, and then we go and review and go back again. And I think what's starting to emerge now from the bits that I understand and the conversations I've been having is that various firms are starting to look at this in different ways from an ESG, if I use those terms, perspective. So for example, talking to Dynamic Planner, they've now got a questionnaire that you can use with clients. Now that doesn't necessarily, it's still part of their risk profile questionnaire, and you can do it in lots of different ways, but they're starting to find ways to help me as an advisor to ask the right questions, to then take it to the next level. from a portfolio perspective, you're then looking at various experts in the field. And as I said, I'm no expert. I'm going to go to other people. I'm going to go to the likes of Jeannie, to be honest, and EQ or King & Shaxton or Bruins or various other people that work in this space. Lots of others that are there that put portfolios together for me. And then the difficult bit, I think, that I find is the whole risk piece, because isn't there two types of risk we have now? We have the investment risk, and then we also have the impact risk. Are we actually investing clients' money to actually make a difference, which is what they want to do? And again, how do you report on that? And I've been talking to a firm called Worthstone, which pulls some really interesting stuff together. So it's a sort of preamble, but at the end of the day, if you haven't got any clients who are interested, what's the point? And I suppose that's where I started from last time. So I haven't got a big practice. I look after about 120 clients, largely high net worth clients, ranging from people in their 20s through to their 80s. So I sent this survey out to all those people, and I asked them 8 questions. And they're all pretty basic because it's all I can do. Just to try to understand, first and foremost, you know, is there an interest? Do they actually understand any of this terminology? Do they want to learn more? And without boring you rigid, I'm happy if anybody wants this little survey, they can either contact Heather or Clive. They've got it, I'll send it to them, or they can give them my email address and I can send it to you if it's of interest. But just a few headlines, I suppose. There were 55 people that answered. So it's a reasonable response. And as I said, it's quite a range of people, so it's worth having. First question I asked was, has the last couple of years seen you change your mind on the environment? And we had 50% said yes, and 40% a little bit. So it's going in the right direction. I think the question that was quite interesting is, I asked, have you ever heard of the term ESG, environment, social governance, as a way of investing money? And the positive was 10%. So only 10% have heard of actually investing in that way, which is sort of what I expected, to be honest, because I actually don't think most people have ever heard of this stuff. The end user. There was 50% that said no, but sounds interested. So it's pretty positive. They're interested. There were 29% aware, but no detail at all, and 10% no, not really concerned. So that's fine. That's part of the segmentation, I think, to actually talk to your clients and find out those people that are interested, those that aren't, because if they're not interested, then why bombard them with a load of stuff that doesn't fit for them? As I said, a few different things in there. And I put another question: if you could invest your money to have a positive impact on the world, would this be of interest? 50% said maybe. We had 12% said no opinion, 30% yes and very interested in this concept. So I think the upshot from a lot of this was that actually, yes, people are interested, but they didn't really know very much about it. Now, it might be because I'm a terrible advisor, but most of these people are people I've dealt with for a long time. They are business people. They're out in the world. They know what's going on. And I feel where we came to was that, yes, there is a real interest, but people don't know much more about it. So for us as an industry, so that's their advisors, but I think that's also the providers, the people that sponsored this research. It's all very well talking to people like me and Jeannie, but actually they need to help us as advisors get down to the end client to understand what this is all about and help us move this forward. As I said, I can go through it all, but as I said, anybody wants to have a look at the questionnaire, feel free. I'm happy to send it to you for what it's worth. Great,
thank you, James. We've actually already had a couple of people in the chat say they like a copy of that, so I think that'll be a really helpful resource. I think where you started talking about being able to ask the right questions is really important. And you mentioned dynamic planners, risk profiling questionnaire, and I think that's one of the really hard things over the last couple of years is there was a lot of product availability and discussion, but then implementing that in the firm level and into client conversations to make sure they're not leading questions, and that you're not getting down into rabbit holes. There was an advisor I was talking to a few months ago who said, I feel really uncomfortable getting into these conversations because I don't want to start judging my clients' values, and that's not the point, right? So I think that was a really, really important point that you made. And then that client survey, I'd be interested in just hearing a little bit about how you're going to implement, what change are you going to make in your business as a result of having done that survey?
Well, behind the scenes, I've then got lots of other comments from people. So there were some comments as well from different clients. So I know one of the questions was, you know, would you like to put some of your money in, all of your money, not interested? I have a number of clients that were interested in putting, say, 20, 25% of their money, of their portfolios into things. My job now is to try to put a proposition together that fits for them. And that's the next stage of this. So maybe the next webinar, I might have done that. But that's sort of where I'm trying to get to. But ultimately, that's one-to-one conversations with clients, and actually then them educating me, me educating them about what's available, what can and can't be done. But that client segmentation thing was really important to me, because of those clients, I know that there are 7 or 8 that are really, really interested and want to look at this further. And they're the people I'll talk to first. And then I'll start to roll it out and sort of further afield.
Great, perfect.
James, can I ask a question about those that aren't interested in ESG? If your general KIP outlook, I mean, I'm interested daily that we've seen the shareholders of Shell have supported their net zero carbon strategic plan. There's the risk factor of ESG, which hopefully all asset managers are going to look at. And I would have thought the majority of IFA clients will be with, in other words, eliminating the risk. So even for those that are not interested, wouldn't you incorporate ESG screening within your general portfolio mix?
Well, I think we're still at the start of the journey, aren't we, Clive? Because, you know, as time goes on, I don't think ESG will almost become a non-event. It will just be normal. In years to come, all of these companies will have to go through this screening and they'll have to do all of this stuff. Otherwise, actually, the way that the capitalism works is money won't go to those companies. The share price doesn't go up. It won't work. So I think it's a gradual process. But at this initial stage, it's more maybe looking at that specialist for 25% that fit with this criteria. But as it goes on, I agree with you, yeah.
Great. Jeannie, can I come to you to talk about how you integrate this into client conversations and how you approach this?
And I think James has raised a really important point with that. So 10%, only 10% of his clients responded yes to ESG. And one thing I would highly recommend you don't do is talk about ESG to clients, because they don't know what you're talking about. I think another company did some research on this, and most people presented with the acronym ESG could not tell you what it stood for. But when it was explained to them, they were very interested. So within the profession and the industry, we've congregated around this term ESG, which is just jargon to clients, and they're going to say no. But if you talk to them in terms of sustainability, values, managing risk, then they're more likely to have a favourable response and actually understand the conversation you're having and not go away feeling a little bit stupid. So there's that. I think it's really important not to go down the route as well of ticking off lists of things to exclude and include. I always try and talk to my clients about themes that we pursue within portfolios. So you're not saying to a client, do you want to make ethical decisions on where you invest, and then going through alcohol, arms, tobacco, and ticking them all off a list. But try and talk about using money to do something that's better for the world. Talk about removing some harmful industries. Talk about values generally. Talk about the changes that they're going through in their lives. If you ask anyone, one of the things that often comes up with clients, I'm going to buy a car. What car are you going to buy? I'm sure more of them are saying Tesla this year than they were last year, because they're making other changes in their lives which reflect their priorities and their thinking around issues like climate change. And those are ways that you can tap into a client's thinking about other areas that they may not actually be connecting with money, but are actually a very, very important part of money conversation. So you can talk about charitable giving. You can talk to clients who are retiring about volunteering. And all of those things will give you an insight into their thinking.
Right, really helpful, thank you. We've had a couple of questions come through. The first one, where did Jeannie and James go to learn and educate themselves on all things related to ESG? And there's an increasing number of courses available. I mean, there's the CFA designation, the PFS have something, I think the CISI have launched something. But then those are credentials of designations, but there's also a slew of information available. Jeannie, can I start with you? Where are you turning to for resources on this?
I think there's a lot of my own learning comes from general financial information. So the Financial Times, very often focuses on issues around climate change. And I think it's important not to put this in a sort of special box. It's part of your overall learning about what's happening in the world. Two specific resources that I really love are Worthstone, that James has already mentioned, and also a website called Fund Eco Market, which is just fantastic in providing learning and also helping to categorize different investment opportunities.
Great.
Yes, well, Worthstone was on the list because I think they've got some great stuff there. I think also in the good old days, you used to meet with people and talk to people from various places and have a cup of coffee, but that might come back one day, who knows? But there's been having slightly moaned about the various providers out there and targeting just us. Some of the stuff they do is fantastic. Some of the webinars and things that have been available. I watched a couple of things from Aviva, which were fantastic. There's some really good, interesting stuff out there that you can just pick stuff up from. As I said, I'm no expert by any means, but the more you listen, you just pick up one or two things, and it starts to slowly come together. But the various providers have got a lot of information out there. And then you can go to the MSCI's, Worthstone. There's lots of stuff on the actual underlying holdings you can do. But to get a good flavour, I think it is that general listen to as many people as you can and pick bits up from everybody.
Clive, do you have anything to add on that?
Yeah, I spent a lot of time on this, and I made it my lockdown project last year. I think as anything, one needs to look at the history. And I would say to anybody, go back and look at the Sustainable Development Goals from the UN and look at the principles of responsible investment which fall out of that. That tells you what the initial ideals were, and they've been updated, of course. And everything about ESG and sustainable investment falls out of that. Paris Agreement falls out of that. The SFDR falls out of that. EU used the term sustainable all the time rather than ESG. So if you look at the history, that takes you back to why. And they sold it to institutional managers on the basis of risk. You're at risk of losing serious money for your clients if you don't take note of climate change, and then the other factors. And then you can build on that. As Jeannie and James say, there is so much you can read there. And I would agree with Jeannie in the Financial Times, Jeannie and Chet, some fabulous stuff in the Financial Times, are looking at it from an industry point of view, from an investor's point of view, not just from our industry's point of view.
Yeah, great. A couple of questions on product. And I'm going to ask both of them, so we can just make sure we get to all of the questions. The first one is it's anonymous, so he or she has written, the biggest problem I have to offer an ESG investment proposition which is aligned with my KIP, but I find there are real gaps in the building blocks and building risk-rated ESG portfolios. And I know this is something we talked about in one of the calls that we had to prep for this. The other one is about badging and the branding of the products. When a client asks to invest more sustainably, is it good enough to offer funds that have been ESG integrated rather than ESG specific funds? So thinking about those two questions about some of the gaps that might exist when trying to offer the full range of building blocks, and then the question about badging. Jeannie, can I come to you first on that, please?
And this is difficult. This stuff is hard. So first of all, ESG integration can mean anything. It can mean that you've used some ESG criteria. It can mean you've looked at a company and decided to let it into the portfolio regardless. It can mean that you've actually done some really serious screening and assessing of companies' ESG records. So I think it's so important to understand the parameters of what each fund is actually offering and what its process is. I think it's equally important to understand what your client means by sustainable, and to what extent would perhaps an ESG focused solution, where perhaps you're looking more at the behavior of a company, the way it operates, or do they mean something that's perhaps more impactful, looking at the company's product or service? So understanding what a fund manager is doing and understanding what your client is meaning when they talk about sustainability are really important. And then when you come on to design, it has in the past been hard to put together a portfolio with the full range of assets, because there are some sectors that are just hard to invest in when you're an ESG or sustainable investor. I think over the past few years that's changed, and in particular we're seeing more opportunities now in the fixed income sector with green bond funds, which are targeted on improving sustainability and issued largely by governments or supranational institutions. So the opportunities are there. I think sometimes you have to go beyond looking at something that is badged ESG to create a meaningful portfolio. And we have to be really clear that these portfolios need to work in terms of risk and return, as well as just achieving sustainability objectives. We're here to deliver a profit for our clients. And it may be that your client is accepting of maybe short-term underperformance because specific sectors like mining, like oil, are not part of their portfolio, but we are here to deliver long-term returns for our clients. And that should be our foremost duty.
So important, absolutely. And I think that financial advisors never forget that, but I think sometimes in the industry discussions, there might be some people who lose sight of that fundamental.
Clients are different as well. You know, I've had clients who would willingly sacrifice or return if they thought they could solve problems like climate change by changing their investments. And sometimes we do have to be the head in all of this and not let our clients run with their hearts so much. There are so many people who care passionately about these issues. So we do have to be in charge somewhat of these decisions.
Yeah, there was a comment that came through on the chat about the difficulty of defining the terms and relating those to how clients express their preferences. And it's not just the term ESG, it extends beyond that. James, can I come to you on the question of finding the building blocks, the range of product that you need to be able to build that proposition, and also the badged versus fully integrated ESG, if I could.
I think this is really, really difficult. Jeannie explains this far better than I probably can, but I think one thing to slightly take a step back. One of the questions as you were talking, one of the questions I asked a client was, one problem is defining the various terms. What may be deemed as ethical by one person may not be ethical enough for somebody else. How do you feel about this issue? And I had 40% said I would want to see some general aims and objectives before making a commitment. And then we had 27%, I'm reasonably relaxed, making a start is better than nothing. I think those 2 points are quite valid. You know, you're never going to get this 100% right. But if you try to get it 100% right, you end up doing nothing. And I think we as an industry have got to recognise that. From putting the portfolios together, I've not gone too far down that line. The conversations I've had is been to outsource it, because I'm no expert in that field. I will go to people and say that this is the client I've got, this is what we're looking at, what can we do? So I'm not going to go and pick funds. You know, I haven't picked funds for a very, very long time. It's just not going to happen. You know, I've been using ETFs since 2008. So, you know, I shouldn't be the man that goes and picks active funds. However, if we ever get to that conversation, I do think this is maybe, and Clive alluded to earlier, this might be the time where actually I would have portfolios of a combination of ETFs and active funds, because I think that's what's probably needed in this, but Clive will pick that up, I'm sure. But I think from putting the actual proposition and the building blocks together, and again, Jeannie said it earlier, ultimately you've got to get the risk right, haven't you? You've got to get the investment piece right, but also then you've got to get the impact piece right. And I think that's where it makes it quite difficult. And pulling all that together, you need to work with, I think, specialists in this market.
Yeah. Clive, I want to come to you, but I'm hoping you can also answer a question about regulation. So maybe provide your comments on that product issue, but then talk a bit about regulation. So there's a question through, where's the best resource for the regulation coming in for ESG? It is happening, but no one knows when. And I know you've been doing a lot of thinking about SFDR and how that might be implemented in the UK. Are you happy to pick that one up?
Yeah, very happy. And we've got Michael Bates online as well, who may comment on the chat. There are some 40,000 listed companies on major exchanges. I think MSCI looks at about 23,000 of those. Jeannie, am I far out there? But nobody looks at all of them all the time. So we're always looking at a set of the market. Some asset managers only look at a couple of thousand. So as James says, don't let the search for perfect spoil what you're trying to make good. You need a partner. Unless you've got huge resources, and very few IFAs have got those resources to do the research themselves. In fact, I'd argue that none have. So you need your partner. The hardest thing for me is matching the risk rating of the individual to the running the money. I still don't really know how we try and do that. Dynamic Planner have done some very good work on this. I know Greg Davis is doing work on it at Oxford Risk. So talk to the risk raters, talk to Dynamic Planner, talk to Oxford Risk, talk to BIQ, because this matching is, I think, terribly difficult, but we've got to try. That's the regulation now. You can't opt out of it. But down the road, you're going to have to follow what SFDR is now saying, which is matching the needs of the individual to the products you're recommending. So you're going to have to know how that product addresses ESG sustainable issues. Maybe not today, but you will tomorrow. So neatly moving on to regulation, SFDR is now in force. I think FE told me that 25% of there's 25% overlap in funds that are marketed here and in Europe, which is quite a good set actually. And if they're marketed in Europe, they've got to say, are they Article 6, Article 8 or Article 9? Articles 8 and 9 are they are genuinely ESG in some form or other. So they've been through a regulatory screening, and FE are doing some work on this. So say, Mikhail, please respond on the chat line if you want to. Come on. I think IFAs are going to have to look at some sort of regulatory screening before it comes in the UK, because I suspect that might take rather a long time. I'm not sure Boris is totally committed to worrying about this too much, but IFAs need to, and fund managers are doing so because of Europe. So I'd be looking at Europe as one way of going forward, but it's only one way. At the same time, you need that partnership with a data provider, an FE on Fund Info, or a Morningstar, or a Square Mile, or an RSMR, try and get morning. And you need to understand what the risk rating agencies are doing in terms of individual risks. So Dynamic Planner, BIQ, and I must say Philometrica as well. I don't know what Paul's doing on this. You need that expertise, because at the end of the day, you've got to try and blend a portfolio. I keep using the word blend. Blending a portfolio is crucial, so you don't have too much of one thing and too little of something else. So the portfolio is balanced and meets the needs of that client. And that's regulation now. It's not regulation tomorrow, it's now. Heather, does that answer that question, do you think?
Yeah, I think so. And I think that Article 9 issue is really interesting. And I'm no expert on this, but can you explain what Article 9 means?
8 and 9, don't ask me too much detail. If you are branding a fund as being an ESG fund or similar in the EU, it will fall under Article 8 or under Article 9. They're two different degrees of compliance of ESG. You can't just say this is a green fund, this is an ethical fund, this is a thematic fund, and whoop, launching in the marketplace, which you can do here. I'm not suggesting anybody is, but you could do. In Europe now, under SFDR, the asset managers have got to get the fund approved under 6, 8 or 9 to demonstrate that it does qualify under the SFDR regulation. So it's been through a screening, which means the European regulator is satisfied that it meets the requirements they set out, which are relatively demanding. Fund managers say they're very demanding, it's pretty granular. But it's the only screening we've got. And my feeling is if enough IFAs and ratings people nag asset managers enough, more will say these are regulated under 8 and 9 in Europe, and you can have confidence in recommending them here. Can I come back to Jeannie? I mean, you must have looked at this, and you've probably forgotten more than I know.
I wouldn't say that as an expert on the regulation, I have to say, Clive. It's something that we would like to see introduced in the UK, because we just think it will make it simpler for advisors and for consumers to understand what they're actually investing in.
Yeah, I think that's the really important.
What's Michelle saying? UK is focusing on climate-related issues, with TCFD alignment being the driver, but fund groups that populate the European MiFID template disclose whether the fund is in 6, 8 or 9. My suggestion we look at those, and it might be a guide to advisors over here.
So I think this plays into another question we've had from an attendee, there's no standard in ESG investing, which we talked about there. There may be, but there isn't yet in the UK. So there's many different approaches and it can get complicated. How do you identify what's appropriate for your clients if they say they're interested? So back to that practical implementation after the needs assessment and understanding their interest in investing in this way. How do you then translate that into product? James, can I come to you first on that?
I forgot to unmute. I think it's pretty much the same answers as to what we've said before, to be honest. It's that you've got to understand your client, you've got to have the conversation with them, and then you've got to talk to specialists in the marketplace. For me, I can't see that I will ever have enough knowledge. As Clive just explained, there's millions of funds out there and there's millions more that come in on board all of the time. So you've got to be able to partner with people and say, look, this is the type of client I've got. This is the levels of risk they wish to take. This is, if you've got the odd person that's really specialist that definitely doesn't want, I know, alcohol and doesn't want mining or anything else, you know, I don't think there'd be very many of those people out there, but the majority of people from the questionnaires and the conversations I've had, they just want to feel like they're doing some good in the world. They want to actually have some of their money actually be working, to feel like there's that, they want to make some money, they want to actually do good. If they can have both, which is really what they're looking for, it's perfect, isn't it? It's hearts and minds as well as the pound in the pocket. So from that perspective, I think it is very much, it's trying to put your sausage machine together, as I said, just described, partnering with providers that you feel comfortable with, that can give you information that you can explain to your clients in English, and the benefits of going into this stuff that fit for that client's criteria. It's just a different way of fact finding, isn't it? Ultimately, it's just a different way of doing things.
Yeah, somebody's put through a question that is exactly the comment I was going to make, that the spectrum of capital can be a good way to help articulate the different approaches. Jeannie, anything to add to what James has said? No?
Yeah, and we use the spectrum of capital approach quite extensively to try and help understand where on that spectrum a client might sit. And I think one of the consequences of this type of investment becoming more popular and people actually beginning to treat climate risk as something quite serious and serious from an investment perspective, we have more clients who are looking to integrate sustainability as a way to manage risk, as well as those clients who are looking to have the positive impact with their money. And I think it's important to understand the motivations between those different sets of clients, because that will point to as to whether an ESG type solution or an impact solution is going to be most appropriate for them. And I think the other thing that I always stress to clients is their portfolio will probably not be perfect, because there is no perfect company and things change as we go along. And again, it's why I try not to go down the list of exclusions, because you can end up, you know, I recently worked with a vegan who started position, she didn't want to have any animal products whatsoever in her portfolio. And I think we have to be clear with clients about what we can and what we can't achieve with this style of investing within an appropriate cost base.
Yeah, absolutely, absolutely. A couple of specific questions. James, do your clients have an interest in where the money is invested, sectors or industries, and negative, positive impact it's having?
Not as yet. Not as yet. As I said, the majority of people I've spoken to is very much a generalist, if that's the right term, that actually they feel like this is something that makes sense. As we started this conversation, you know, the majority of people didn't realise that they could use their pension funds, they could use their investments to invest in a different way. That's the starting point for a lot of people. So to then get to the granular of, I want to go into this, I want to go into that. Now, our industry thinks that might be the case, but actually the end user hasn't had that thought process, again, in my humble opinion, for the majority of our client banks and the advisors on this call. There will be, of course, some, and they will already be probably talking to people like Jeannie, because that's where they are. But the majority of the advisor community and their clients, this is still very, very early stages. So to get to a point where they're actually specifying where they want to be and what they want to do, I don't think we're there yet, to be honest.
Great. Thank you. And I have two questions for Jeannie. The first one is about client reporting. How do you deal with client reporting, and do you get enough support from data providers, asset managers to produce your reports?
So in one respect, there's the standard performance costs and charges reporting that we would do for any clients. And then we come into the issue of trying to measure things like impact and the sustainability criteria of a portfolio. And yes, we could do with a whole lot more support from asset managers to do that. We go through a process. We use data from an organisation called Argentum to provide us with details of carbon footprint, so we can measure carbon output and carbon intensity of our portfolios. We also then try to measure each company in the portfolio against one of the UN Sustainable Development Goals. And we're doing that by basically sitting down and going through every company, using publicly available information in their reports to shareholders to capture, again, more information about carbon, more information about their products and services, to try and allocate each tiny shareholding that our clients have to bring the impact of the portfolio to life for them. But it's hard to do. It's hard work, and it involves a lot of people with a lot of words in a very big spreadsheet.
The second question is really related, and it's about, the question is, EQ investors are a specialist wealth manager in the space. What are the key challenges you face, and what can asset managers do to help? So you've already mentioned that asset managers could help. So any more specifics around how they can help with the key challenges and what they can do to help, not just with reporting? Yeah,
I think the key challenges is around terminology and helping communicate the differences between different sustainable approaches to people. And I think it's up to us as perhaps an industry to push towards a common terminology, so people understand what we're talking about. That's a key challenge for us. We've been doing this for over 10 years, and when we started out, people said we were mad, and we had a lot of pushback. There weren't products available. Everyone said you're going to lose all your clients' money. You're bunch of city types or bunch of hippies masquerading as investment managers. So it's been great to sort of see everyone adopt these ideas over the past few years, and that's really improved the availability of opportunities that we can select from. So the more everyone gets on the bus, the better the outcome is going to be for clients, I think.
Yeah, great. James, you mentioned at the beginning of the webinar that that asset managers and product providers could do more to raise awareness to education with clients or create client-friendly communication. Just wondering if you have any other thoughts on things that asset managers or other product providers could do to support you.
I think what Jeannie just described is also really, really important. We as advisors see the headline email that says ESG, and therefore it goes in our head, and therefore we use that when we talk to the client, and actually it's not very helpful because as we both just said, nobody understands what this terminology is. So I think collectively it would make a huge amount more sense as an industry to try and work out ways that we can talk to the providers can talk to us, that we can then filter down to the clients the same messages. So that just all of us talking together would make a lot of sense as far as that's concerned. I think from an end user, people collaborating with the providers on little videos, market commentary, how it's always dangerous when you're talking to fund managers because they're talking a different language. So you then have to try to disseminate that down into a language that a client understands. But I think, I saw working together as an industry trying to provide information to the end client is really valuable, rather than being told, here's a load of stuff, what do you think? Actually, why don't the providers talk to the likes of Jeannie and say, actually, what is needed to help you with the end client? And it's having those conversations will actually get you to what you want. But it's rare that happens. Yeah,
great. I think that client-friendly language is really important, and ESG probably isn't the right place to start. So, Clive, you and I are guilty of it too. Clive, before I pass to Alex, is there anything I'm sure you want to add something to?
Just on that asset manager piece, talking to one asset manager, it felt like I was interviewing a director of the CIA. To actually get information was bloody hard. And I think we need asset managers to be much more transparent about their process. what they do is up to them. So if they say everything goes through an ESG screen and we can ignore the recommendation, that's fine. We know what they're doing. If they say that recommendation can't be ignored, we know what they're doing. If they're absolutely clear, but we don't think all of them are making it quite clear to their own distribution teams, because we seem to be getting slightly different answers from time to time. I think advisors and gatekeepers such as FE need to really stress around asset managers. You must be transparent on what your methodology on ESG is, because if we don't know, we can't make the right advice, and we will ultimately be not running with regulation. In fact, we're not running with current regulation because you're supposed to match your client needs to the product. So just keep driving that. We want to know what you're doing, guys.
Yeah, great. Thank you, Jeannie and James, and I'll thank you again at the end. That was absolutely fantastic again. Alex, can I pass over to you to share our 5 questions?
Yeah, thank you, Heather. I think, as you mentioned earlier, but I'm Alex Johnson, a quantitative researcher at NextWealth. In a previous life, I spent an awful lot of time helping financial institutions put together client engagement studies and various surveys of their clients in order to figure out what they want. So I should probably caveat up front, I'm not an ESG expert, but I've spoken to several. And I've hopefully synthesized some of that down into these 5 questions. So let me just quickly share my screen here and walk you through them. So first and foremost, I just would caveat sort of in terms of our methodology. This is sort of the first sort of fact find that a lot of people will be doing, a lot of advisors will be doing on their clients. So it's important, I think, to kind of follow 3 mantras. You need to keep it quite high level. And as Jeannie mentioned earlier as well, you need to try and avoid as much jargon as possible. I tried very hard throughout the 5 questions to not mention ESG at all. I think that's quite important. And then I think the third point is don't be afraid to educate through the questions. And I'll share a little bit of what that means, but there's a difference between leading and educating, and it's important that you do so, especially on a new topic, so that you inform people to make reasonable responses. So without further ado, I'll quickly take you through them. So question number 1 is around creating objective-based profiles. So what does that mean? It's about understanding where do your clients lie on a sort of a spectrum, if you will. Spectrum of capital is sort of the basis for this. And the question itself, considering the balance between your financial return and impact, where on the scale best describes your objective for your investment portfolio. And in this instance, again, it's important to be specific and provide a definition. So in this case, we have defined impact as generating positive, measurable social and environmental change. You can put in your own definition. You may not agree. We're still finalizing out of the sort of, as you said, the jargon, but that sort of was my crack at it. And I put it on a sort of a scale. So a scale of sort of financial returns first to impact first. Some people would say use a 5-point scale. I think because it's an early study, I'd challenge you to remove the middle option. You don't really want fence sitters. You want people who say, I want returns or impact, because that starts to generate more interesting results and allows you to be more actionable in terms of saying these people want this or that. Okay, question 2, identifying resonant terminology, which is a pretty long-winded way to say what we've already said, is that there's a lot of terms floating around out there in this space, and we haven't really decided on any singular term. So it's about asking, what resonates with the end client. So the question itself, when looking for investments, which of the following labels or badges best reflect your preferred approach to investing? And the cohort are sort of the ones you'd expect: ethical, sustainable, thematic, impact, responsible, ESG, conventional or no badges required if people actually have an opinion on that, other if they're looking for other things or simply don't know, which is quite possible. Third question, clarifying intent via a case study. And again, that's quite a broad term, but what I think is important to do is to give a more tangible example so that you can get good opinions on a specific event. In this case, I've used Boohoo. So the question itself, should fund managers look to exclude stocks that are deemed to have behaved badly, for example, Boohoo, in terms of treatment of staff and working conditions, or companies that do not have a good environmental track record? Very simple question, yes, no, unsure, but the purpose of it is to be very clear and give a clear example of where you might want to exclude a company and to get feedback on that specific point so that you can be very clear in terms of like, this is something they want or do not want. Fourth question, whoop, skipped ahead. Determine deal breakers. We're moving slightly sort of 1 foot into KYC territory potentially with this question, but I think it's important. And it's important to understand how much would each of the following factors alter your decision to use your investment portfolio to create positive impact. I've done a simple 3-point scale. You may want to extend that. I think it's early days, keep it simple, lower scales, get more sort of definitive results, but the factors sort of are the typical ones you'd expect. Higher fees, potential for lower returns, more time required for decision-making, a higher risk of losing money in the short term. It is negative. You're going to get negative responses. The importance here is to not take those negative responses as do not do this. It's if you are going to provide ESG, then these are the things you need to be aware of. These are the pressure points for your clients. These are the things you need to say, yes, the fees will be higher, but you will get this. So I think that's the rationale behind it. The fourth question, I was actually really pleased to hear Jeannie talk about this, but it's a question around charity, because this is sort of, charitable giving has been the traditional route to achieve good with your finance. And it is important to, I think, use it as sort of, again, another sort of icebreaker or an identifier for clients who may want to do more or less ESG. And again, it's a very simple question. Do you currently provide support or donations to foundations or charities to support specific causes? And a sort of a standard list, frequently, very frequently, occasionally, rarely, very rarely, never. So that's it. It's 5 questions. And I think hopefully this serves as a baseline. It's never wrong to ask more questions. In fact, I was hard pressed to select only 5. We would expect that you'd add more questions to, address the specific needs that you have. And we're always open to have conversations around what would be a good question or a good fit for your business, or if you wanted to check a different thing. But without sort of further ado, I'll pass it back over to Heather to close things out.
Great, thank you, Alex. So now those are some questions that we thought would be helpful as market researchers, because sometimes when we talk to financial advisors who are looking to put together surveys of their clients, they're quite nervous about not asking leading questions, particularly on a topic like this. So we hope those are helpful to you, not meant as fact find your KYC, but as a survey, similar to what James talked about earlier. Thanks, Alex. Thank you, Jeannie. Thank you, James. Thank you, Clive. A fantastic session. We'll email around a copy of those questions, and anyone who's interested in James's survey with his clients, drop us an email as well. And with that, thanks very much, everyone.
Well, thank you. Well, take care.
Bye, James.